I actually resigned before I had the idea. I created a burning platform. So, those big decisions, sometimes you just need to create a burning platform, leap off and then figure it out. We burned through $3 or $4 million over a couple of years. I think I just about bankrupted myself twice in the first year. Ran out of money, had to borrow money off the in-laws. It was pretty tough. Contemplated selling the house, didn't quite get there. And then of course we had to live with the consequences of that, which is you binge drink at a party and you're gonna have a massive hangover, right? And that's fundamentally what we did. What we do is we broker the mass market and then we use our product to deliver into what we'd say are profitable niches, parts of the market that are broken. It's a bit like any industry, that creative destruction process where it's very hard for the incumbent to compete. If we sold out to an existing established player in market, that would be a cop-out. I love creative thinking, I love problem solving. I'm not the most structured person in the world, and the reality is when you're sort of trying to run a company, you need to.
Today on the show is JB, John Bolton from Squirrel. What an incredible individual. We talk about raising money, we talk about getting listings through Snowball, talk about failing at a 35-unit residential property development. He's very candid, very open, and bloody amusing. And he's forgotten more things about property in New Zealand than most of us will ever care to learn. Stick around and enjoy the show. John Bolton, JB.
Hey.
Welcome to the show.
Good to be here.
So the internet tells me you're a slightly off-the-wall and energetic ideas guy. I've known you for about 15 years. I reckon that's pretty accurate.
Yeah, I was going to say, it feels pretty accurate.
Pretty accurate, right?
Yeah.
So you left the ANZ, a cushy corporate job, managing a $60 billion portfolio.
Yeah.
At what turned out to be the start of the GFC in early 2008.
Yeah.
Put your house on the line, you took your superannuation out, all of your money, put it into this venture. We love to post-rationalize things, but if you look back on that decision, like at that point in time, would it still have been the right one for JB at that age and stage, or would you have done it differently knowing how the journey played out?
Yeah, look, I had a healthy dose of naivety. I think that's the way I always describe it. But I think if you're going to make a big jump, you actually need a bit of that. So no regrets, but it was way harder than I thought it would be. They say 10 years to be an overnight success. I think we're working on 20. And I've aged a lot in that process, but I wouldn't do it any differently.
What was the impetus for you in the first place to leave this no doubt super well-paying corporate gig and with all the trappings that came with it? What made you go, I'm going to go off into the startup space and build a lender/broker/platform with a difference?
Yeah, look, I think we're only really just getting to our potential now. So, and I'm sure we'll talk about that. But the thing that I'm still surprised about is I was so young. So I was running a big chunk of ANZ, general manager of product, so basically running a bank's balance sheet. I was 32. Wow. 32. Like when I look at my team now, I'm like, I was that age. And it's like, it's hard to comprehend that I was given that much responsibility at that age. I still don't get it because I look at 32-year-olds and there's no way I'd put them in charge.
Nor probably you, if you look back at your 32-year-old self.
If I look back at myself, I think they were crazy. But anyway, they did. And so I was running a big part of the bank.
Hey, so just while you're pondering that,
yeah.
So I spent a short amount of period in a corporate, like 3,000 people, and I wanted to see what that experience was like. I anticipated that I wasn't a corporate guy. The lessons that I learned about that is that you have to be very, very good at gaining consensus from people, getting decisions made without making it look like you're getting decisions made, taking risks, but someone else is the exposure to that risk.
Yeah.
So those were my corporate experiences. And I've known you for a long time. I would not see you as being a corporate guy. So what do you think it was that the bank saw in you that enabled you to have that like an incredible career exposure at that age?
I think, to be honest, it sounds stupid, but probably intellect. And creativity. So problem solving. I was just a very, very good problem solver, and a huge amount of self-drive and motivation. I mean, what happened when I was in the bank at a very young age, I just used to take on things without being asked to do it. So I just go and solve problems for the bank. And then I just go to the executives and say, hey, you've got this problem and I've actually thought about it and here's a solution. And I literally did that. So it was kind of weird. Like I did things like one of the big problems for a bank, just give you an example, is cash. So we had tens of millions of dollars of cash floating around the system and we have to move it with armor guard trucks between branches and ATMs and stuff. But the bank had no idea, and it costs the banks a lot of money holding cash because they're paying interest to their customers, and yet this cash is sitting there not earning interest when it's physically in the network. And so it was the only time I've used my calculus, maths from uni. I actually built them a model to optimize cash holdings. So I used calculus to work out the speed that money was moving around the system and where it was tending to land, and then the costs of moving it with armor guard and stuff, and saved them about $2 million. And no one asked me to do that. I just thought it was a cool problem to solve.
Right.
And I just kept doing that. And then they let me set up my own business unit. And this is at 27. And so at 27, I set up a team called Business Advisory. And a lot of the guys in that team have gone on to do really good things. And we were an internal consultancy to the bank where the job of my team was to go around and solve problems. And I loved it. And then the problems just got bigger and bigger. And I found myself getting sort of over-promoted.
Wow. You were the Winston Wolfe division of the bank. Tarantino reference, you'll get it.
Yeah. And look, yeah, so I did well, but I'd hit my glass ceiling and I knew it.
Because above you were reporting to executive, like a CEO?
Yeah.
Wow.
Yeah.
Okay.
So the next moves for me were, ultimately was sort of a CEO role, and there's no way I could do it. I just didn't have I'm not the right kind of person for that level of responsibility.
What does that mean? Unpack that for me.
Look, I am a bit mad, a little bit creative and a little unstructured, and I'm not the best leader of large teams of people. I can be a bit all over the place. So people like me, but it doesn't make you a great leader, right? And so I sort of hit my glass ceiling. I was the kind of the maverick inside the bank. They liked me because I was so off the charts. And that was fine for a while, but you end up getting boxed into a certain space, and I'd done my dash.
Yeah. Aristotle says that it's the greatest journey of discovery is the discovery of the self. And so did you know that about yourself at 32? Because self-awareness for us as men typically doesn't hit until we're in our 30s. And I'm in my 50s now, and I'm still discovering things about myself. So did you know that you weren't that guy, or did you realize that later?
No, I did. It was ironic, actually, because as part of my executive journey in the bank, they'd given me a coach. And I remember the first meeting I had with my coach. He said, look, we're going to go through a process, and a significant number of people that go through this process leave. And I didn't leave at that point, but within 2 years I was out.
Right. Had you talked to your coach about the idea of Squirrel?
No.
Right.
No. And to be honest, I didn't really have a clear sense of what Squirrel was going to be when we launched. I actually resigned before I had the idea. So I created a burning platform. So, those big decisions, sometimes you just need to kind of create a burning platform, leap off, and then figure it out. And that's what I did. So I kind of saw a need in the market for sort of optimization solving. So network solving, problem solving around sort of efficiency and productivity. And that was something I'd done a bit of in the bank. I actually loved it. I loved those sort of issues. Even like roading infrastructure, figuring out the best way of optimizing cars on a network. Those sort of problems are really cool to solve. And so that's kind of where I was getting excited. And then I always wanted to set up a bank. I always wanted to do a startup bank. I talked to my boss about that when I was at ANZ, whether or not we could spin off sort of a digital bank. And it wasn't really conceivable back then, probably still isn't now. And ultimately, that's why I left. I just couldn't see the excitement in just continuing to do the same old job.
Yeah.
I wanted to start up a bank. So Squirrel, if we get to Squirrel, I had an earlier idea around something that was going to be called Get Savvy, which would have been stupid. But that was much more orientated around maybe an interest.co.nz type of scenario, price comparison, empowering people through giving them lots of free information to be able to make better financial decisions. I couldn't figure out how to commercialize it. Squirrel came out of wanting to create a digital bank, not having the capital to do that personally. So going, well, where could I start that would have a low entry point? And mortgage brokering was the place to go. It was still quite nascent. 2008, the internet was still quite young. And so to me, that traditional broker market had been very much property investors. And we saw an opportunity to get in there and sort of really target first home buyers, start to use the internet, start to build a brand, start to advertise, start to do things differently to, I guess, how that industry had been evolving.
Yeah.
And that's kind of how it started. It started with a view that we would get to where we are now. So I think we're finally arriving, in the last year or so, we're finally arriving at that point that I saw 17 years ago, but it's taken us 17 years to get there.
How long did you think it would take at the outset?
Well, my business plan said 5.
Okay.
It said 5, it's taken 17.
Yeah, wow.
Yeah.
I mean, that's why you say the overnight success used to be 10 years, now it's 17 years.
Well, 20, I think.
20,
We've still got 3 years to go.
Yeah, wow. Okay. Hopeless planning is invaluable. Misquoting Eisenhower there.
Yeah.
And so was it the regulatory environment, the access to capital, the economic environment? What was it that has meant that it took 300% longer, maybe 400% longer than you anticipated?
Look, the starting point would be that brokering, if we just start at that end, which is relatively simple, is quite people intensive. So it's not an easily scalable business. It might be if you're a franchise system or if you chose a system where you're just turning it into a product and then scaling the product, right? That would be far more scalable and far quicker. We chose to go down a salary model, which means you've got a high fixed cost base, and it means that you scale a hell of a lot slower, but it gives you more control. My observation of the franchise model is that the revenue split between the franchisor and the franchisee was far too skewed towards the franchisee, and that you wouldn't have enough money to invest in brand, technology, and the rest of it. So a salary model, slower because it's a fixed cost, but it gave us more funds ultimately to invest into brand and technology, which is what we've done. It's staggering, really, because I go back to the first year. We got super excited about writing 30 million of mortgages. And it was tough. It was GFC. It was tough. I had never dealt with a client before because I came out of head office, and we were going backwards. So I think I just about bankrupted myself twice in the first year. Ran out of money, had to borrow money off the in-laws. It was pretty tough. Contemplated selling the house, didn't quite get there. And we're going to move into the office, but we didn't have a bathroom there, so that would have been really awkward.
Two young kids.
Yeah, two young kids under 5. So it was, look, it was first few years were super tough. We grafted it out. We gradually built that brokering business. We got it up to $1 billion of mortgages a year. And then we wanted to then start to execute the next phase of the journey, which is we'd sort of started to build a brand. We'd sort of started to build some scale and distribution. And so then I wasn't sure if I wanted to go down the non-bank deposit taking license route, which is sort of finance company route, still regulated by the Reserve Bank. We couldn't become a bank in New Zealand. And even now, digital startups struggle because of this requirement to have 50 million of capital. So that was never really going to be an option for us. And so I didn't really want to be regulated by the RBNZ. They didn't feel like they could cope with small innovative businesses. So that peer-to-peer license that came out around that time, that that looked like it could work for us. And it looked like an entry point that we could play with. It felt like the right technology. It's kind of interesting. So we launched the peer-to-peer platform. We launched it with a consumer finance product, a personal loan product. It was highly unsuccessful. We never wrote a lot of personal loans, but what it did allow us to do, and Harmony came out and they just flew. They did really well.
What did they do differently?
Well, I think that they lost a lot of money for a start.
Right.
They invested heavily in marketing, building brand, and just went for it. Lost a lot of money, raised a lot of capital. But they were singularly focused on personal loans, whereas I think for us, we were singularly focused on mortgages, and it was more of a side hustle just to sort of see how it would work. And then we pivoted away from the personal loans into mortgages, which was always the intent. And then it's gradually taken off from there.
Yeah, as in writing your own mortgages as opposed to selling the bank's product.
Yeah. And so the way I describe us today is that we broker the mass market because the margins are very skinny, and banks have a sort of a monopoly benefit in that they have very low cost of funds. So to be honest, my view is that a digital startup will struggle to compete with banks in the mass market. You just won't get to their level of pricing because you can't achieve the cost of funds that they have. And so what we do is we broker the mass market, and then we use our product to deliver into what we'd say are profitable niches, parts of the market that are broken. So today for us, that's construction. So we're one of the largest non-bank lenders to the construction sector. And that's because, we've just been through a 2-year recession. Banks completely stepped away and abandoned that whole sector. And that was an opportunity for us to step in with some innovation, some good products, some good credit policy, really understand the customers, take on some risk, and do a really good job of it.
Yeah. And so your funding of that, how do you go about accessing the capital to be able to distribute?
So we raise that through a combination of our peer-to-peer platform and managed funds. And what's interesting is I'd sort of say that peer-to-peer in a pure sense is actually a technology. So it's fractionalization of investments. If you think about it, it's a precursor to decentralized finance, DeFi. Everyone gets caught up on the crypto side of it, but the core to it is actually a network. And I think with peer-to-peer, that's what we've got. We've built this peer-to-peer system, this literally digital bank that exists on the cloud. And that underlying infrastructure, I think, is really valuable and quite important long term. And it's really sophisticated. Now, and people interact with that, and they invest onto the platform, and they buy loans, and they can trade them. There's a secondary market for it, which has got quite high levels of liquidity. And that works really, really well. Then we've got managed funds, and we've overlaid managed funds on it. And originally, what we thought would happen is that we would convince fund managers to come onto our platform and start buying and selling investments and trading. That didn't happen. New Zealand's quite conservative, and everyone tends to sort of move in packs, and they tend to just like to stick to what's tried and true. So no one, we got a couple of fund managers that were happy to dabble with it, but we never really got them coming into the platform. So we thought, bugger it, we'll set up our own managed funds, which we've done. And those are growing really quickly. And I think managed funds are really easy for the market to understand because it's an old product. So what I'd describe is we've got this old product that everyone understands, managed funds sitting on this kind of new infrastructure, these digital rails. And I'm quite excited about that. So it's not one or the other. It's not, let's just do managed funds. It's easier, cheaper. We're sort of doing a combo because I really do think that the underlying technology is going to have a much bigger role to play in the future.
Yeah. How so?
Well, I believe in DeFi. I think decentralized finance is the future. I don't think we're clear yet how we're going to get there.
Could you just break that down for us briefly, the DeFi, what it means and how it works?
Cutting out the middleman. So, I mean, if we think about it, it's happening everywhere. Uber's is an example of it. Airbnb's an example of it. And you'll get the same sort of examples emerging in finance, but possibly in different ways, right? Now, the thing in the finance space is that there's two technologies that are playing out there. And I think we can get a bit confused sometimes between them. So you've got crypto, and that sort of whole distributed ledger technology. And then you've got peer-to-peer networking. And we're not crypto, so we're not tokenizing assets. We're not running on a crypto technology at the moment. And the use cases, to be honest, haven't been strong enough for us to take that dive, right? We're still exploring it. I'm still trying to understand where those use cases are, because I think they'll emerge, but they're not really there yet. But we're absolutely in the peer-to-peer space. So we're connecting borrowers and investors directly. And yes, we are the intermediary, but we're connecting them directly in the marketplace. Now, what's kind of unique about this peer-to-peer model is that it literally behaves like the banking system. So we don't have liquidity risk, because borrowers, investors are directly matched into a loan. So if the loan doesn't repay, the investor doesn't get repaid. The investor can't get their money out unless either they sell their investment in the loan or the loan repays. So as a platform, we don't carry the liquidity risk. Now, the biggest risk for a bank or a finance company is liquidity risk, right? It's short-term deposits, long-term assets or loans. And the run on the bank is when depositors start ripping their money out and the banks can't liquidate the loans, right? We don't have that risk with that platform because everything is match funded. Which is incredibly powerful. And if it's match funded, that means you don't have to hold as much capital. So when you sort of start to unpack it and you go, okay, it's match funded. And then what we also do is we dynamically provision reserves off the back of the borrower payments that protect the investors. And in the event that the reserves aren't high enough, we can haircut the interest to all investors in that asset class to replenish the reserve fund. Well, that's very similar to how the banks operate with what's called OBR, which is the Reserve Bank's ability to effectively shave deposits across the banking system to prop up a bank.
Yeah.
And so we've built this system that fundamentally behaves like a bank, but isn't a bank.
Yes.
It's kind of cool, right?
Yeah, it's really cool.
Hardly anyone knows it exists because it's just a technology that sits underneath this thing called Squirrel.
Yes. And I'm guessing that this is one of the key things that the banks have been endeavoring to stop, based on this being an existential threat to them, because they've built their whole thing on trust and brand and, we're going to assure your money. And I think they're government guaranteed, if I'm not incorrect.
Yeah.
And so they're probably kind of beating the drum pretty hard. Lobbying, bribery has been around for the longest of times. One of my favorite stats is there's more financial services lobbyists in DC and Washington than there is politicians. There's 5,000 lobbyists just for the financial services sector, and there's about 3,500 politicians. And so the power that they wield over the United States, and my hallucination is that we have ripple effects around the rest of the world, because these massive, super, super powerful, very wealthy financial institutions, which I believe do govern the United States, entertainment and financial institutions are those that actually have the power, and then the military, of course, in the background as well. And so they've been kind of seeing this existential threat and risk. And one of my theories is that the AML KYC that has become such a niggle for us over the last 5 years, it's just increased.
Tell me about it.
Oh, I mean, you're right in the middle of it, right? And so every time I need to go and do a transaction on something, and if I'm transacting with a new party, then I have to go through the process of being validated. And I'm like, my belief is that this was brought in by the banks, because it makes it so much harder for a new institution to get themselves validated, because they're like, it's too much of a hassle. I don't have to go through this. I'm just going to stick with the brand that I know. So I've said a lot of things there, but I'm curious about what the bank's response to you has been, and have they been in the background kind of agitating, threatened by you? Sam Stubbs is a wonderful man and also a great advocate for kind of, hammering these big brands over the heads. But what's your view on all of that I've just said there, JB?
Oh, look, we have an interesting relationship with our banking partners because as a broker, we're working with the bank.
You're selling their product.
And then I guess the way that we would view it at the moment is that where we tend to build our own product is in parts of the market that are broken. And so we actually see ourselves working in a sort of cooperative sense almost with the banks, and that we're working with the banks on the stuff where they're the best at it, i.e. they've got the lowest cost of funding. And then where there are broken markets, we're building out product where we can be the best at it. And we're not necessarily competing with the bank. So if we take the construction sector, for example, they probably feel like we're starting to compete with them now. But for a long while there, they'd exited the market. So I don't think it's too bad, but they don't care about us at all. Like, we're a pimple on the ass of an elephant. It's like, banks are so big. I used to run strategy inside one of the banks, and I was involved in the very early days of Kiwi Bank. So Kiwi Bank originally wasn't going to be its own thing. It was going to be a joint venture with Westpac.
That's right.
And Westpac did do the warehouse. I don't know if you recall, but the warehouse tried to launch a financial services business.
That's right. This is probably 15, 20 years ago.
Yeah. And that was around the same time as Kiwi Bank, actually. So Stephen Tyndall had a crack at it. He wanted to do something. It didn't work out. And then Kiwi Bank came in and probably was heading in the same direction as the warehouse, which is banks don't really want to give up what they have. And so that whilst they might partner with you, they're not great partners. And so I think that was one of the big steps for Kiwi Bank, was when it decided to go on its own. And it was a big call at the time because they didn't have the banking infrastructure they needed to get up and running. I think they ended up buying a system off a building society or something that had recently folded and spun it up that way. But for a while there, that was meant to be a joint venture with Westpac, and it just wouldn't have worked because it's a bit like any industry, that creative destruction process where it's very hard for the incumbent to compete or to offer up new services that compete with the core of their business. You can sort of see it with Google at the moment, right, with AI, because AI is radically changing search and incredibly fast. And, for Google, it's like, I think they had as good, if not better, AI for a long time, but they've been really reluctant to bring it to market because of the impact on its own business.
Yeah, 100%. They bought DeepMind in 2016, $450 million, the total leading AI platform play at that time, the best minds in the industry. Sure. And they just kind of shuffled it away into the corner and then left it there and said, we're protecting this massive amount of ad revenue, like hundreds of billions of dollars a year of ad revenue. And Google searches last year were down 30%. Searches down 30% and click-throughs down by even higher than that, I believe.
It doesn't surprise me. So for the first time ever, we're seeing AI-generated referrals into the business. So, it really surprised me. And it's amazing how quickly it's happening. Is, when we're looking at where our customers are coming from, it's the first time that we're actually seeing AI coming through in a meaningful way. And then what's really interesting is that it's a much deeper search. So when you go into the AIs and you ask them, hey, you're referring people to us, what are you telling them? It's really interesting, right? And it's really interesting to see the journey that people are going on. In the old days, you very much had to do that with your web page. You had to think about that sales funnel and you had to go, okay, what are those objections? How do you take people on this journey to get from this awareness to, to actually basically buying a product? And it was a bit of a process, and it's almost like you've lost control of that process now because the AI is doing it. So, they're coming in and they've got a problem that they want to solve, and then the AI is actually taking them through a process. And it's it's mind blowing the process it's going through. But it's also, for any business, I think it's really good to go into these AIs, prompt them about your own business to see what sort of journey the AI is actually taking your prospective customers on.
Yes.
It's nuts.
Yeah, that's a really good tip. Go to an anonymized or someone else's machine and do some research on your own business so that you can kind of see what it is that the synopsis, the short form description is, and then what prospective customers can see. So what did you learn about Squirrel and how accurate was it to assessing your business?
Oh, incredibly accurate. Incredibly accurate. But, the thing is, the thing I'd say is it picks up your entire history.
Yeah.
So this is the world that we're moving into, right? So I always think of Minority Report with Tom Cruise, where
most of those things on there have come into reality post the production of that film. It's incredibly prescient.
Yeah, totally. Let's not talk about Terminator. But Minority Report, where you have no crime in the world because crime simply can't exist because everything's known before it happens, right? And I kind of feel that with where we're going with AI now, your entire history on the web is captured. And so, whilst you could sort of argue that it gets lost over time, it does for a human because it stops dropping off the search results. But
Page 7.
It's page 7 or shit. We got that down to page 10. Thank God, that bad review. With AI, it's just all accessible. So it's quite remarkable how deep and how rich the AI is getting in terms of its understanding of your business, just simply from everything that's available.
So you know this now, and you've got a leading you've always been out at the forefront of kind of digital adoption. So what are you doing inside Squirrel now as a consequence of how you understand that AI is behaving? What's your reaction to it?
Oh, I think that's really recent for us. So I think we're sort of working through it at the moment. But look, what it means is it's probably the next iteration of SEO, right? So historically, we've thought about, okay, how do we write? What do we write so that it shows up in search results? I think we're going to be increasingly thinking about how do we write, what do we write so that the AIs interpret our business better. So what aspects of our business do we need to almost like train the AI on because it's not really got a full or rich enough response for something. So for us, particularly around the investment side of our business, because I think that's where we're seeing AI the most, is, the biggest question that people ask is Squirrel risky? Can I put my money there? What sort of protection do I have? Now, is it safe? And these are fundamental questions. And the AI is pretty good because, it goes down and it understands the reserve fund. It understands it better than we do. It articulates it incredibly well. Understands the reserve fund, it understands matching, it understands the nature of the peer-to-peer network. So it actually articulates it really, really well. But when you start to sort of understand that those are the questions that people are asking, then you sort of go, okay, well, what added richness can we start to, publish, that would give that AI an even better experience, or the customers using AI a better experience.
Yeah. So the 3 words that would stand out for me of what you just said there is content, story, and journey. So investing in those. Those are 3 important pillars, and this is where my belief is, by the way, of brand. And so we've come kind of full circle around to the 1960s, 70s, 80s, and a little bit of the 90s, where brand was king. And then we got lost in the space of the internet, and then all of these new companies turning up, and Google who, and Amazon what, and Face what, and all these sorts of things. And so now we've come back all the way around to brand actually being the most important thing that you can invest in. That's my personal hypothesis now. What's your view?
Yeah, no, I totally agree. I think brand's incredibly powerful and a really important differentiation for the future. The one thing I'd say that the positive about AI is, I've always been worried about the fact that, we do have clients that have bad experiences with us. You never want it, but it does happen. And, so you get the odd bit of negative feedback. It might be on Reddit or some that exists somewhere on the internet. And you worry that somehow that defines your business, that you get defined by one bad review or something. I think one of the positives with AI is that it can pull together so much information, it can keep that in context. It's doing a good job of keeping that in context because of the sheer volume of what it can look at.
Yeah.
And I think that's really important because, all you need is, Google search, you got this kind of comment on Reddit that sort of organically is showing up at number 3 or 4, and then you're sort of like, oh shit, I hope that doesn't define our business. Whereas AI, I think, does a much better job of keeping context.
Yeah, I agree with that. And inside your business, what else are you doing in relation to utilizing the large language models, the predictive analytics, the other bits and pieces that are around in the world of AI?
I'm agitating on it at the moment. I've thrown myself into it. The best way to get everyone on board is just dive in yourself. I used to be a long time ago now, 30 years ago, I used to be a sort of a programmer back in the day. It's funny, I can still read code. I can't write it now because it's changed so much. And I wouldn't want to attempt to. But I've thrown myself into AI, not in any deep level, just essentially training agents, getting them doing stuff for me. I use a lot of AI for research, writing, even video production now. I've got a AI version of myself that can speak every language in the world, which is just nuts.
More than you, probably. Yeah. This is actually not you in the studio. This is JB's
this
avatar.
Is my AI version.
Yeah.
Look, it's super cool. I've got AI writing music and songs and just having fun with it. It's irreverent stuff, but what it is doing is just helping the guys start to embrace it at work all the time in terms of everything that they're doing. And I think we are getting rapid adoption now within the business of people just using it as a productivity tool alongside what they're doing. To me, that was the starting point. Where we're starting to head now, so our technology team's definitely using it a lot more. They're using it co-pilot type scenarios where they're using it for coding reviews. Starting to think about building out all of our testing with AI. I think we're using sort of GitHub for a lot of that. So there's a bit going on there. In the advisory side of the business, we're really experimenting with it at the moment in terms of its ability to write advice summaries, bank submissions. We're using it to check documents, so AI checking documents so that we know that we've got what we need before we submit. We're looking at using it in meetings to basically summarize the meetings, but trained agents so that there's a structure to it.
Yeah.
Because they know what they're looking for, so that it comes back more as an advice summary. And so I see it fundamentally as a productivity tool. That means it will take a lot of the process out of our business and then allow the advisors to spend a lot more time, I think, doing higher value human activities. So we kind of want to get them away from their computers and get them in front of their clients a lot more. And I kind of feel that that's where that's gonna head for us.
Yeah. My hypothesis is if you look at some part of the world in which you played, you rub over competition-wise with some of the bigger banks, and enterprise by its very nature tends to be very slow to adopt technology. And there's a lot of stories about companies locking down large language models and locking down data access to these things. And I understand the reason as to why, but the consequence of that, of course, is that challenger brands and smaller, more nimble companies will be able to utilize the magic that is sitting inside the box there and kind of really race ahead. And so I think you imagining that kind of to be one of the enablers to kind of get ahead of the competition.
Yeah, look, I think AI mostly against the big bank incumbents. Because I agree, I think they'll be incredibly slow to adopt AI to its full potential. They will. It's going to take them years, and yet this technology is moving so fast. I think smaller businesses will adapt to it incredibly quickly. I don't think AI will be it may be a little bit of a competitive advantage with the banks. I do think it's mostly going to be a productivity tool, and that it's going to be the other aspects of what we do, how we reposition our advisors, how we get them into a higher value context that will be really critical. I still think that for us, for our business, the biggest differentiator is product. That's we invest into brand, we invest into technology, we build most of our own tech. We obviously built this peer-to-peer cloud-based thing. And we built our own broker platform as well, and our own workflow processes. So tech plays an important role in that. But ultimately, tech is an enabler. I kind of feel that people catch up on tech. So it's only ever a temporary advantage. And I think that's true in our industry because there's plenty of businesses that are investing in tech. For us, the big differentiator is product. So our ability to not only broker, but then have innovative product that we're developing that solves problems that no one else can solve. And the fact that that product is only available to our team means that as we build out more of that product differentiation alongside brand and tech, I think the product differentiation is for us going to be the single biggest enabler.
Thanks for listening, and apologies for the interruption. I wanted to share with you that this show is one that we, the team, collectively pour a lot of effort into. There's resources that are involved. We have producers, promoters, and wonderful guests that share their time with us so that you may learn and possibly, hopefully, make some impact on the world as a result of that learning. The only thing I ask of you is go and check out my website. There's a diagnostic tool on there. There's a free downloadable chapter of my upcoming book, remarkably called 2 Commas. And there is some other fascinating resources that I'm not going to tell you about because you need to go to the website to check them out. So thanks for listening, and please continue enjoying the show. So this is the 2 Commas multi-million-dollar exit show, and we've had a really interesting conversation to get us to this point.
We haven't talked exits yet. No.
Let's talk about that. So about 9 years ago, you did a strategic raise through Snowball, and you were the sole founder of the company, so by far and away the majority shareholder. I know that you've got an ESOP pool available for your team members. We'll talk about that later on. But you raised $3.5 million on the Snowball effect. So talk us through that journey. What did you learn about it along the way? Why did you do it?
Yeah, so I was definitely at a point where we needed to raise capital. We had a high fixed cost base, broker business. We were wanting to launch into peer-to-peer lending. I'd started that investment prior to Snowball. We'd pretty much got the base platform up and running. But we weren't running as fast as I'd like, and we were always spending every dollar we had, which meant that we weren't resilient if we had shifts in market conditions. And I think the issue that we've had with the housing market for a number of years is the volatility in it. It's just been hot and cold so much. As much as we've just been through this massive recession for 2 years, which has been gnarly. And we wouldn't have survived that 10 years ago. The only reason we survived it is we've had enough time to build up a resilient business. Just these ups and downs, they were existential threats for us. And I was getting frustrated with what would happen is we'd end up with a housing market that would slow down at a time when we're investing, and then we'd have to put all the brakes on and just stop investing, bunker down, cut costs, get through it. And then you get to the other side and you go, right, we can go again, start investing. And then suddenly the market slows down again. It's like, oh, no, brakes back on again. I was conscious of a couple of things. One thing I'd seen so many founders and startups take capital too early and get severely watered down. And, I saw examples where founders were literally walking out with nothing because they just get watered down.
To the single digits sometimes, which is just horrendous.
Yeah, and then you can see it even now, and I won't name any, but you can certainly see it. Look, I love when I see businesses going and raising capital. I love going into the capital table and just seeing how much the founders have been watered down. And it's generally huge. So if there's one success for me is we've grown slower, it's taken longer, but I've managed to retain a much larger share of the business. So I'm still at 60% of Squirrel now. So going into it, I was getting frustrated. I was trying to do it on my own, but I couldn't build up enough capital to keep investing through the changes in the cycle. So we went to Snowball. We raised $3.5 million, which was a lot of money at the time. I spent it way too easily. And
did it feel like it was like because it was someone else's money and it hadn't been capital you'd built up inside the business? What was there some sort of conscious rationale that
I don't entirely know. I think I'd been holding back so much, and I had a real cost discipline that was super good. And then suddenly having money in the business, the cost discipline kind of got dropped a bit too much. And because you could, you did.
Yeah.
And there were things I wanted to do, and I think getting, and you hear a lot of founders talk about this when they raise capital, is that you've got to maintain that cost discipline. We were going through an interesting phase of the business at that time. The banks had changed the way that they were dealing with brokers, had changed the way they were paying commission. It was quite negative for us. And so we had to ride through that. So we probably lost in cash terms. I think we still reported profits, but it was paper profits. In cash terms, I think we burned through $3 or $4 million over a couple of years. And it was tough. But on the other side of it, I think we built resilience. The other thing that I've done, so there was a capital raise, and I think it was well timed because we went into a recession, a mild recession, around the same time that we raised that capital. And so we made losses, but we had enough capital that we could ride through it without restricting the business too much. Along the way, we've been very good at bringing in money, not necessarily equity. So I only did the Snowball raise. That was about $3.5 million. Then I tapped 2 private investors, one Chinese VC, and another sort of investor. I tapped them for $1 million each. So they came into Squirrel, and that was the last time that we actually raised capital. So I think we've raised about $5.5 million in total. We absolutely needed it. We burned through it. After that, we didn't raise capital. I actually went and borrowed from the bank. So debt's way cheaper. And you obviously don't dilute shareholders. So, whenever we could, we went and borrowed money from the bank, and we generally borrowed more than we needed. And I think that worked incredibly well for us, because I think, I don't know who said it, but someone famous said, always borrow more than you need.
Yeah.
Right? Because you can't get it when you need it.
Yeah.
Right? And I think, God, that's probably the best piece of advice I've ever taken. So whenever we've had the opportunity to borrow money from the bank, we have, and we've always taken more than we needed. And in hindsight, that's always been a very wise decision.
We have a similar mantra in startup world, actually. So raise more than you think that you will need, because you'll be raising again in the future. And so you can do clever things with convertible notes and safes so that you don't dilute yourself too much now. You can push it down the path to a future round. But if you've got the opportunity to take 2, you're raising 1 now, take the 2 all day, every day.
I really needed to talk to you 10 years ago.
And here we are. Yeah. So that got you through a good period of time. You've weathered the most recent recession well as a business. How's that gone for you?
Very well. Yeah. Look, I think the thing for us is we're diversified now. So whilst you could argue that the housing market has slowed down a lot, and therefore our brokering business, which is actually still growing, has had a harder time growing in the current market, the lending business has taken off because the parts of the market that we've been in have been broken. And so, construction lending has been awesome for us in the last 2 years, even though, technically the construction sector's a mess at the moment. We're playing quite successfully in there.
you chose it because there was a clear problem, and so therefore you turn up with a great solution, and hopefully you can match up customer and problem together. Have you garnered some insight along the way about, oh, hell, I didn't expect this to be kind of an issue in this space, construction lending?
Yeah, look, what I would sort of say with construction lending is it's an interesting one, right? Because at the big end of town, big developers, you're thinking sort of, $100 million projects and stuff. The banks are generally all over that. And if the banks aren't over that, then maybe some of the really big finance companies are. There's specialist finance companies out there that do that stuff day in, day out. But they're very traditional. They have nice sort of pinstripe suits. They drive around in flash cars, helicopters, you name it, right? And that's that kind of market. It's the kind of big money end of town, and that's what it looks and feels like. There's a much smaller part of that market because you go from the very large transactions to maybe a single house build. And at that other end, it's got some of the same complexity, but on a much smaller scale. But no one's got a strong service proposition into it because the guys in the pinstripe suits don't want to talk to the little guys. They don't want to waste their time because they can't generate enough fee income. And then the banks aren't very good at looking after it either. So what we've sort of done is we've come from a retail perspective where we're dealing with, just regular people, helping them with home loans, to sort of saying, well, how do we look after that small end of the construction market, individual builders, group builders, small scale development, look after that stuff really, really well. And then how do we do that differently? And so we're overlaying a lot of technology on that. So we're using our peer-to-peer platform. We're overlaying a lot of technology on it. We're stripping cost out to make it much more affordable for those guys. So I think we'll end up with quite a strong cost advantage, which will largely be driven by technology and our ability to service that market with a relatively low touch. And that's the differentiation. And then I think overlay that is also, and I think this is really important, values. So there's the technology, but I think the brand piece there is actually very values driven. So our philosophy in that space is very much be fair. Charge what's fair. Don't charge what you can charge. So like in the construction space, I think construction finance is very expensive. It's a high risk market. The banks have exited it. It's been filled with finance companies. They take their pound of flesh. We've still got to pay investors. We've still got to, earn profits and stuff. But how we go about that, I think, is a little bit different.
I really love that as a value, that fairness approach. And I've got a mantra: just because you can, it doesn't mean that you should.
Yeah.
I'm a commercial property owner. Most of it's industrial, some of it commercial. And there was a tenant that was sniffing around recently, a space that I had, and we were second option for them. But I found out the option that they took was a 2-year lease, of which they got 18 months free. And then the real estate agent gets 2 months. So the landlord gets 4 months of 24 months in rent because the tenant could. And I thought, that's just a real dick move for someone to do, right? Just because you can, it doesn't mean you should. It's lecherous behavior. And I believe that will come out in the wash for them in one of their business dealings down the path because it's really predatory behavior. And so, you can be on either end of the transaction and be predatory, but your decision, and I laud this for you, is to go, let's be fair and reasonable about this.
Yeah.
Because you're going to build a better business over time, right?
Totally.
About 12 to 14 years ago, I remember you telling me that you'd just completed a small-scale residential property development. 35 units, I think, from memory.
Yeah, 35 townhouses.
35 townhouses. And I remember you saying to me at the time that, holy shit, that was hard. And I don't know if I'll ever do it again.
Yeah, and I haven't.
Interesting.
That was my university education. It costs a lot. That was like a Harvard degree. We lost money on it. But, interesting with that one, again, values-based, right? So we went through the sunset date, so we could have cancelled all of the agreements and resold the development. Our builder...
It's actually more.
Yeah, it's substantially more. We'd have made a $7 million profit. Our builder had gone under. So our project was literally locked down. It was fenced up to stop suppliers going and stealing stuff from it. Our builder had gone under, was bankrupted in the process. We had a fixed price contract with the builder. They couldn't honor it because there being cost escalation. They weren't particularly good at managing the project as well. But there'd been cost escalation, and they couldn't honour the contract. They basically folded on it. So we were stuck with a half-finished housing development. And we navigated our way through it, which is remarkable, mostly because my business partner that I was doing it with, was a builder. And so we were able to sort of get in and get it done. We went through the sunset dates. We could have cancelled all the agreements, resold it for a $7 million profit. We didn't. We working with the bank, we agreed the amount of money we needed to get the project finished, and we put through a 5% price variation on the sale and purchase agreements and then extended them. And so what that meant is that the buyers got a really good buy. And in theory, we would have got out and not lost anything. But that's the theory. The practical reality is that Auckland Council is an absolute nightmare to deal with, and as is Watercare. And by the time we dealt with them getting through delays on connections and getting everything finished, I think we ended up losing close to $1 million between us.
Yeah, that's remarkable. It's the third time I've heard a version of that story. Someone who comes from the money sector or the corporate sector and then goes into small, medium scale property development and then almost but not quite loses their shirt and loses about 5 years off their life through stress and cortisol release. And in the other two instances, both of them made the same decision, which was to not sunset the buy clause, and so to let the buyers of the homes take the capital gain that had gone on along the way. And so I really respect that. Back to your capital play within Squirrel. So you're poised for more growth. What's your capital strategy from here into the future?
Yeah, it's a good one. Look, I think when we did the snowball raise, which seems like a lifetime ago now, we signaled that our intention was to list. So we signaled that right back in Snowball Day. And I think for a while there, those snowball investors, probably felt a little bit let down, to be honest, because they came in, excited, and it just seems to have taken so long for us on this journey. I think the last couple of years, we've been hitting some really big numbers, and, I think the shareholders generally are pretty happy. We've been paying dividends. We started paying dividends last year. And I think as soon as you start paying dividends, shareholders get happy. Well, you're either listing or you're paying dividends. And we started paying dividends last year. So I think a lot of that noise has disappeared now. They're starting to feel like they're getting a good return on their investment. But we did promise them that we would list. The thing that's made that so difficult is the housing market. And it feels like there's always been one excuse after the other. But, post-raising money through Snowball, we had the Royal Commission in Australia, and that was really serious. I don't know if you can sort of recall back to that, but
I remember the headline, but not the detail.
Yeah, so there was a very real possibility in Australia that broker commission was banned.
So your business model would have been defunct if that had flowed onto New Zealand.
Yeah. And so at the time, that was an existential risk to the industry and certainly to us. So as the Royal Commission was going on, there was no way that we could raise capital full stop. Like no one really wanted to put into capital into a business where your model could get sort of stuffed by a Royal Commission. So that was happening. And then post that, sort of prior to COVID, Auckland went through a bit of a mini recession. The housing market in Auckland, and we were predominantly at that stage an Auckland-based business, the housing market in Auckland kind of really lost its heat. What happened is not so much that house prices fell, they sort of plateaued, but there wasn't a lot of buying activity. Like the market up here was really dead. Not so much the rest of the country, but Auckland was. And again, so if you were talking to investors, they were like, firstly it was the Royal Commission, and then it was like, well, the market doesn't, people were nervous about the housing market. And I think if you sort of remember sort of that sort of pre-COVID, there was a lot of talk about the market being overheated, about people feeling that there needed to be some sort of correction. It had got away on itself. And then ironically, and so that was a conversation at the time, and investors generally weren't excited about the housing market. Most investors that I've dealt with tend to think about export-based businesses. The idea of a domestic business doesn't excite them because they can't see that it can scale enough to make good money. I think there are two exceptions to that. So healthcare is one and finance is the other. They're both scalable. The mortgage market in New Zealand's probably getting close to 400 billion now. That's a decent sized market. So, and our banks collectively, their profits are huge, right? So, there's two spaces that you can build enough domestic scale to actually build a pretty significant business, and finance is definitely one of those. But convincing investors of that's actually really hard. And so there's always been a reason why, hey, good business, but there's this element of your business that we're not sure about, and for a long time that was the housing market. And then COVID hit, and so COVID became, a reason. Then post-COVID, there's always been a reason that people have been nervous about housing. Where we're at the moment is that, we grew through that whole period. So we've been able to sustain reasonable levels of growth, generally about 20% year on year, through a very turbulent time in the housing market. We've been able to grow our lending business and not have credit losses during arguably the worst modern recession we've seen since 92. And some of my peers, older peers, would say that the recession we've just been through for them has been harder than 92, even though the unemployment rate back then was way higher. So we've come through that. We've continued to grow through that, which I think sets us up really, really well for the future. We're coming off a housing market that's been through a major recession. I think when the next cycle starts, and you just got to remind yourself that economies do roll in cycles. When the next cycle starts, we're going to have a good cycle. And so we're coming into a good cycle off the back of a long period of stable growth in a challenging environment. We've got high levels of IT, technology innovation occurring in the business. We've got some big innovations in the pipe that I think are seriously big. I can't really talk too much to them. And so we just feel that we're now getting into that space where our story is strong enough that listing's back on the table.
Amazing.
So it's been a journey to get here. Look, one thing that I would say is we've been listing ready for about 8 years.
What does that take to get listing ready?
So I totally over-invested in governance. So we're externally audited. So our auditor is KPMG. They've been doing our audit now for, I'd sort of say, probably 8 or 9 years. We produce an annual report of listed quality. So we don't have to. We could just produce a set of financials, right? But we don't. We produce a really high quality annual report. This year's one's going to look absolutely stunning. We've got a board of directors with independent directors on it. I've always had that. We pay them lots. But we've got a full board of directors. I'm not CEO anymore. I've got a CEO in the business. I'm just founder. We produce our financials within 3 months of the year end because that's what we need to do as a listed company. And we've practiced that for the last 8 years. Mm-hmm. We do quarterly shareholder updates. So we've got a lot. When you go through the requirements for listing, we're actually probably 90% of the way there. The bit that we've been missing is the cohesiveness of the story. And what it feels like now is that the story's coming together really nicely, and it's taken this long to get us into the right place. Our desire at the moment is we're not doing an IPO.
So you do a private placement?
Yeah, well, I think it used to be called a compliance listing, but okay. I'm not sure what they call it now. And look, we've still got to work through that process. It's nothing formal. This is just in JB's head. We've put a line in the sand and said, look, we've been talking about it for a long time. Let's aim for next year. What does it look like? We've still got a lot of decisions to make, but where my head's at the moment is we don't necessarily need to raise capital in that process. I say not necessarily because, we're still going to have some discussion around that. I think we've got directors whose view will be that we should. And so maybe we will. But my starting point on this is a compliance listing. Get on there. It's not about making a buck and getting out. It's actually much more about brand. It's about brand trust. We're a financial services business, so that level of transparency and public accountability is good for trust. Certainly good for the brand. And it's about creating liquidity for shareholders. Not so much me, but for all of those smaller shareholders that we've taken on the journey, giving them an ability to exit. I might take a little bit of money off the table, but I'd probably do that pre-listing as opposed to at listing. What we don't want to do is overhype and underdeliver. We want to kind of earn our way into the market. Success for me is a slow and gradual increase in the share price, which is driven by fundamentals. It's a good business and it earns its way onto the market, as opposed to what I think Kiwis have experienced historically, which is the old pump and dump.
Yeah, 100%.
Which I hate.
Oh yeah, it's despicable behaviour. My food bag being the most recent example. The directors and CEO exiting millions of shares just post-listing, and the banks pumping it up, and this fundamentals just not stacking up. It was a terrible investment opportunity.
Yeah.
So pump and dump was very much in the background.
Yeah, and look, we thought we would have a crack at it a couple of years ago now. I'm struggling to think if that was pre or post COVID, but we did have a crack at it. We had Cameron Partners come in and have a good look at the business. What I would say is we went through a bit of a process to go out and sort of try and find a cornerstone shareholder. For me personally, that was, at the time, I needed to sell down some shares. And that was fundamentally driven by having too much debt.
Personal debt? Yep.
Oh, yeah, way too much. And so I was looking to just sell down, and I thought it'd be a great opportunity to get a cornerstone shareholder in that could then take us from where we were, to the prospect of listing, or some other version of that. I think, look, there's an interesting point in here for me, why part of listing, so brand, right, and creating liquidity for shareholders, but there's another reason for me personally, which is anchoring the business as New Zealand owned, and not a trade sale. Yeah. So there's something about our brand and our ethos and what we're trying to do that says that if we sold out to an existing established player in market, that would be a cop-out. Yeah. And I would feel incredibly bad about that. And so would my team. They would feel that they'd been sold out by JB. For what we believe in, that can never be an exit. For us, what we represent has to be enshrined by being owned by New Zealand. And the place to do that is on the stock exchange. That's really important for me. And so I envisage for myself, long term, myself and Annalisa, that we will remain a cornerstone shareholder in that business, but it will be publicly listed.
You've been quoted publicly as saying that you're building a business that you hope to last 100 years. And so this is a manifestation of that, right? You're approaching 20 years in business and you're talking about a listing and, close to that kind of double decade era. And so it's really you manifesting that into the future, right?
Yeah, 100%.
Yeah,
100%.
I love this. Have you considered a SPAC or a backdoor listing? It probably wouldn't achieve what you wanted to from a brand standpoint, but is that something that's been floated around?
Yeah, I think in a way that's almost similar to a compliance listing, right? I think sort of either way, I think that the primary thing for us is just get on there in some sort of relatively quiet way, keep costs down. We don't really want to go overboard with spending money on this stuff, and then just gradually earn your way into it. It's the idea of earn your way into it that I think is really important to all of us, is that we don't feel the need to list and then sort of
Big fanfare.
dance around and ring the bell and woohoo.
Yeah.
It's more of a just a process of getting in there and then earning our way. But we've still got a lot to do, and we don't want to get too excited because we're only part way on that journey.
Yeah. You're a very ego-driven guy.
Yeah,
and so
totally.
I know that about you, but people who are watching this and coming across JB for the first time aren't. And so earning your way in is like a demonstration of you not needing to be the big chest beating, look at me, I'll ring the bell at the NASDAQ or in the New Zealand Stock Exchange kind of situation. Do we ring a bell in New Zealand when we have a listing? I don't know.
I have no idea.
We've had precious few of them over the last few years, and so I'm really pleased to hear that that's something that you're considering doing and bringing to life the intent for it to be a 100-year plus kind of New Zealand entity. Interestingly, with the trust set up in New Zealand, we've just changed it so that they can live for 120 years, a trust can now, which is more than a lifetime these days.
Yeah, well, at the moment.
Yeah, at the moment. Yeah, exactly. Yeah.
God knows how long we'll live.
Who knows? So New Zealand property market, the residential sector, it's one that you've had a lot of exposure to through the business over the years. You've done a lot of commentary over the years. You've passed it on to some of your team members now. But what's your view on the long term? You mentioned that you can see it coming back into the part of the cycle that'll be a growth phase again, is what I'm reading between the lines. You didn't use those words specifically. But what's your view on the NZ residential property market?
Yeah, it's an interesting one, right? I remember probably 7 or 8 years ago saying that the housing market needed to have a major correction, that it had completely gone overboard. And, and I said that, and then it surged another 20-odd%. And then it finally had the correction, a couple of years ago. I was 6 years early, or, yeah. But I mean, ultimately, the property market needs to be driven by fundamentals. I think success for us as a country, and even for people in the industry, is for an industry that's or a sector that's far less cyclical, and getting rid of those peaks and troughs. Smoothing it out a bit. I think in any business, long-term predictability and reliability is actually really important. And we just don't have that. And so for me, incomes typically are growing at sort of around 3.5% to 4% year on year, if you take a sort of long-term view on it. And that's what I would expect to see the property market do. It should largely follow income growth. So there will be a level of underlying growth, but we shouldn't see the kind of highs and lows that we see through that market. Generally, what drives that is when people meddle with it.
As in OCR and changing immigration laws, is that what you mean?
Well, immigration's a massive
impact.
Yeah. Our inability to build at scale and consistently build in different parts of the market, governments meddling with it, and then of course the Reserve Bank, driving it through the OCR. The OCR went far too low during COVID. At the time, I couldn't understand it. It made no sense to me how low it went. I honestly think we were just following the US.
Yeah.
I don't think it was independent thinking in terms of looking at our economy and deciding what to do. It felt completely wrong, and we saw the consequences of it. And I don't think we all foresaw that. I think partly because of this whole living from home or working from home thing, the amount of investment that just went back into the property market at such low interest rates was nuts. And of course, we know that in hindsight, and then of course we had to live with the consequences of that, which is you binge drink at a party and you're going to have a massive hangover, right? And that's fundamentally what we did. So look, I think the market will come back a bit. As much as, Auckland and Wellington are down around 20% in absolute terms, they still are finding their bottom. I still think there's a lot of softness in the property market, but it's just starting to turn now. That's 20% in terms of an absolute drop in prices, but if you think about the inflation over that period, the real impact is actually down about 30-35%. And that's a massive fall. Historically, when I was in the bank, those were the sort of falls that we had to model for the Reserve Bank to show if we could survive it. And, we've actually ridden through it relatively well. I mean, it's a big part, I think, of what's contributed to this recession is that households just haven't had money to spend.
Yeah.
And that's flowed through the whole economy. But we've come through it surprisingly resilient. And so look, from here, I think you'll get a bit of a bump at some point. That bump will be driven by an increase in confidence, and it will be driven by an increase in immigration, which fundamentally requires jobs growth.
Yes.
So, I think everyone sort of thought you drop interest rates and suddenly everything's okay. It's not, right? You can't knife someone and then, pull the knife out and go, oh, ha, all over. It takes a while for people to recover. And I think, you can see that in the confidence numbers, consumers are still not feeling good about the world, and it's going to take them a while. And then we've got this added complexity now of everything going on overseas. World War III could break out in the Middle East at the moment. We've still got issues with, sort of Russia and Ukraine. You've got China and Taiwan. You've got India and Pakistan. You've got the first president, I think, that has had military marches for his birthday. I mean, surely that's a sign of a dictator. Anyway, there's just a lot going on. Until we see that rebuilding of consumer confidence, which allows people to start to open up their wallets a bit. Business confidence, same thing. Businesses actually forward investing. Job creation, that's what starts to drive the next wave. That job creation will then start to lift immigration, and because the building sector's been in such a bad state for a while now, we're going to end up in the same place that we always end up in, is we're going to be underbuilding relative to population growth. Now, initially, there's enough surplus stock that, it will be okay for a few years, but eventually immigration will get ahead of our ability to build. Yeah. And we'll end up in a sort of probably much more sort of positive cycle for property. It's a shame. I'd like to think that having failed at this so many times, we would be better than that, and we would be able to maintain a level of building that can keep pace with population growth. And then my bigger hope is that we get higher quality population growth as well. I kind of think we're not that smart. We tend to open and close the door.
Yeah, and anyone who's got their foot in there can come on in rather than thinking strategically, what is it that we need in this country?
Yeah, I think I'm quite sarcastic on this. I think we've got more nail technicians per head of population than anywhere else in the world.
That would sound about right in my neighbourhood. Yep.
It's great for my wife, but
actually, I have my nails painted at the moment, so there you go.
Oh wow!
Yeah, it's because there's so many of them.
Yeah,
I'm supporting that industry, one man at a time.
Oh yeah, look, I mean, I think there's some really interesting challenges for us around, how do we create the New Zealand that we want in the future? Lots of really interesting conversations to have. How do you get foreign businesses investing in New Zealand when you have these sort of 3-year political cycles where we flip-flop from, quite different views on how to run an economy? Good luck getting oil and gas investors into New Zealand, because...
Or big tech putting data centers in here or whatever it might be.
Well, the risk is that, you have a green-led coalition, or not a green-led coalition, but a coalition with a Green Party that decides that it doesn't want any of that. And that's always there, right? I mean, we've got obviously a national-led government, but you've got to say, coming up to the next election,
who knows?
Who knows, right? The risk is back on the table, and that's a risk that we're facing every 3 years, which makes it really difficult for businesses to make investment decisions, because the policy extremes are quite big. There's quite a big gap left and right. We don't seem to have managed our way in the middle particularly well over the last
decade or so. Yeah, I agree with that. Yeah, we think from the outside, we like to see ourselves as a centrist nation, but we've been kind of flim-flamming quite extremely from the politicians, the people that we're putting into the House, to put the legislation in place that governs how we, supposed to act. And it's been fairly much more extreme, which I guess is where the world's been moving to as well, right?
It's
Extremism
a worldwide phenomena, yeah.
Yes.
This polarization of society. And look, I think social media and the internet have a really big role to play. And the thing that I find so remarkable is even amongst my own friends is seeing people I'm seeing people getting trapped in echo chambers.
Yeah.
You sort of, even with your own friends, you're like, oh my God, that's such an extreme view. And then you realize that their news and their world view is so curated.
Yes.
It's scary.
If we're going back to that political conversation, one of the big challenges that New Zealand has is that we have no long-term strategic plan. So there's no central anchored infrastructure and growth plan. And so that's why we see rail or roading or ferries or, whatever it might be. And infrastructure from building and running a city, that stuff is really unquestionable. We need better water, better sewage, better treatment of all those sorts of things, yet we can't seem to agree upon it. And so you look overseas to places like Singapore, which is my favorite and often quoted example. We all know it's a benign dictatorship, but how well run is that country?
Yeah.
It's phenomenal. 50-year plan, really well thought out, great strategists and interventions. And it's just a wonderful, safe place to travel to.
Yeah. You need a benevolent dictator. That's what we all need.
That's what we need.
Hard to find.
Yeah, really, really hard to find. Yeah, exactly. Yeah, a good, kind dictator. That's what Donald's trying to style himself as. So, yeah. Speaking of dictators, that's actually a really awkward segue. And David's not a dictator at all, but you hired an external CEO. You replaced yourself about 18 months or so ago.
Yes.
What was that journey like?
I think for me, relatively easy, because I think through my career, I've always sort of checked out of leadership roles. Yeah, look, I know my strengths and weaknesses, and I love creative thinking. I love problem solving. I'm not the most structured person in the world, and the reality is, when you're sort of trying to run a company, you need to put a lot more structure over it. Get everyone pointing in the same direction, get the alignment. And look, that's not my strength. I hate writing board papers. I just have a total dislike for writing board papers. I hate having to write stuff down. I hate PowerPoint. So I wasn't very good at it because I wasn't very good at doing PowerPoint presentations to the board. I wasn't, I wasn't a well-organized and structured leader for the business. So I kind of felt that I was starting to hold it back, but I was also spending far too much time doing the things that I didn't love. And I felt that my job had turned into a job of admin and people. As your business gets bigger, more people problems. So people-related issues, admin. And it's just not where my natural strengths were. And so Dave, who I've known for a long time, he was actually my first boss when I got into banking. I knew he was available. And at first, I didn't think I could afford him. So it wasn't really a conversation that I was going to take much further. But then I'm like, actually, if we want to scale this business, I need to step aside. I need to bring someone in that is good at the things that I'm not good at. And that's going to allow me to focus on the stuff that I'm really passionate about. And so the start of that was literally putting him in the job and then stepping back. But I stepped right back. So I stepped right out of his leadership team and then just spent the next year as an advisor in the business.
As a mortgage broker.
As a mortgage broker. So I literally stepped out of his leadership team. So I had nothing to do with them for probably that first 12 months or so. I'd still get involved. I was still a director, but I literally left Dave to kind of establish those relationships himself and really stepped back from it. And I think that was good for me. It was hard. And at times you sort of can feel a little bit in the wilderness. It's your business, and yet you've kind of handed over someone else to run it. I stepped back into the leadership team after a year because I felt like I had a lot to contribute. and wanted to help get some things sort of shaped the way that I felt they needed to be shaped. And so I sort of stepped back more, and you could almost say as a co-CEO, but I'm not. I'm not at all, but I definitely work quite closely with Dave around the strategy and what we're trying to achieve. And then I drive the advisory business. But even with the advisory business now, I'm starting to step away from that more, and sort of trying to create that next level of leadership coming through the business. I don't really want to be the leader. I don't feel the need to be the leader. I don't know. It's like having kids. You just want them to grow up and then be proud of them. That's kind of what I want. I want to see the business thrive, and I always want to be involved in it. But I don't feel the need to be front and center. I hate being the center of attention. At work, everywhere. I'm actually quite shy. A lot of people don't realize that, but I am actually I'm quite a shy person, and I don't like being in the limelight.
Mm-hmm. A lot of founders get to a certain stage of their journey, 7 to 10 years is often what I observe.
Yeah.
And they're really, really disliking a lot of their existence because they've created a job for themselves that they hate. And so I have a really simple exercise, can't remember where I got it from, but it's take your fist, put it down on a piece of paper, draw a circle around your fist, and then inside the fist, write all the things that your functions, your responsibilities in the business that you personally have, accountabilities that you love. And then outside it, write all the things that you hate about your personal job inside the business. And just look for the balance there. It's pretty simple, right?
Yeah.
And so most people, when they do that exercise, it takes about 20 minutes. They realize that they've filled their life with stuff that they don't enjoy and they're actually not that good at doing. But they feel that because they've started the business, that they have to take ownership for that thing. I can't pass that on to someone else. It's intrinsic upon me. But then the other consequence is that they not only hate their existence, but they've also created a job for themselves that's really unfillable because nobody wants to do it.
Yeah.
And it's a collection of functions and responsibilities that doesn't exist in another human being.
Yes.
And so the best thing you can do, and I love what you said there, JB, was you invested for the future. You spent more on that job in the short term than you possibly should or could have, but you realized that you were building for 3 to 5 years out. And that takes time. Leadership transition takes time. You've got to go through a journey of change. The business has to get accustomed to a new style and approach and mechanisms and tools and the other things that would have changed along the way. And so what you've now got is that you've been able to come back in with a clean, fresh set of eyes. You can see where the opportunities are for the business. You can drive the listing. You can be the chief brand officer, Chief Squirrel. Do you still have the title Chief Squirrel?
No, I gave that to Dave.
Okay, wow.
Yeah. I'm founder and OG now.
OG, yeah.
So that's me now. Look, I actually really liked that time. I like the time to step back and get that helicopter view. Because I think, there's a huge richness of experience in the business now, but sometimes you're so stuck in the weeds that ability to step back and just get super clear on strategically where you're building that competitive advantage. I'm a huge believer in competitive advantage, differentiation, and just getting sort of super clear on where you're driving that in the business. And the other thing I think is really interesting is not making excuses. It's really, you said it earlier actually, it's really easy to rationalize your answers. Yeah. It's really easy to go, it's really hard to break that cycle and actually challenge yourself to go, actually, maybe that's not right. We've rationalized our way in here, but we actually need to do something differently. And you can only do that when you can step back and look in.
So my parting question always is the alternate universe. There's another JB. He chose not to be a squirrel, but rather something different. And he's got deep career satisfaction. What's that job that the other JB in this alternate universe is doing?
He's a builder.
A chippy. Okay, a carpenter. Interesting.
I've got this thing, like, I love the trades.
Yeah.
But I think if I was to go back and say, right, JB, let's do it again, I'd go into the trades.
Huh.
And the reason for that, I love problem solving, but I just think there's such a massive opportunity in the trades to build scaled businesses. You get lots of guys go into the trades and they'll be one-man bands, and there are very few who really sort of step up to that next level and start to think about more than being on the tools. If you think about it figuratively, not being on the tools, but being able to step above that and then actually build businesses that are scalable. And I kind of, whenever I look at the trades, even now, I still think it's a massive opportunity. I think it's really interesting sort of seeing a lot of the new building techniques and seeing businesses, high levels of innovation getting applied to the way that they build. And I just love that. I love the problem solving. I love the innovation. I love seeing these guys building these scaled businesses in that space. But fundamentally, it comes down to this core skill set of being a tradie.
Yeah, nice. I had Shane Brearley on the show and gifted his company to Simplicity Living, obviously, and he's open sourced his building methodology. And so he's made it available freely for anyone to go, this is how you build at 35% less than the rack rate, which is remarkable. And he started as actually a surveyor, I think it was his entry into the industry, not as a builder. My own exposure to that is that came through on a rural property for a period of time. So about 9 years old till about 15, 16 years old, I worked on the family rural property, putting up barns, putting in irrigation, putting up fencing, shelter belts, all that sort of thing. And so we're knowledge workers. We've got computers on our desks and we talk to people and we sell things. And so there's something just deeply innately satisfying about getting your hands onto something and then constructing something, making something. I've lost most of those skills. I know you've got a couple of black nails. Are you still out there building things? Are you pounding?
No, I'm jamming my fingers in doors.
Okay, right. Different problem.
Problem, yeah.
JB, always such a rich chat. I really love your values-based approach to building and running businesses. I've loved following the journey with Squirrel. I'm really excited about where you're going with the opportunity for a potential future listing. Really, really grateful for the conversation today, JB. Thank you so much for coming on the show.
Yeah, no, thanks, Josh.
Awesome, bro. If you enjoy these episodes, I hope you do. I love filming them, and the guests always say what a great and often cathartic experience it is for them. Then please do like and share. Hit me up on LinkedIn. I'm open to connect requests, and occasionally get emails from people as well asking me about my experience around certain subjects. So please do like and share and continue to follow the show. I really appreciate your ears.